Many high net worth Canadians have done an excellent job in building their wealth through their business, through their careers, or through their investing. But as they transition into a different stage of life, other priorities start to take shape. And today we're going to talk about some of those other priorities. So I'm happy to introduce Ahmad Bakshai, Associate Vice President of the Advanced Wealth Planning Group with Wellington Altus Private Wealth. Thanks for joining us today.
Thanks for having me.
Ahmad, for the viewers, I was hoping you can give us a quick introduction to yourself and your career path and how you've ended up here.
Sure. So like you said, I am an associate vice president with the Advanced Wealth Planning Group. What we do here is we're a centralized team of specialized planners, and we're here to help advisors and their clients plan for their lives and achieve their objectives. Personally, about myself, I've been in the business for about 15, 16 years, and I've worked with different financial services firms in the industry in different roles. I have a pretty strong technical background, I would say, and I would call myself an advanced generalist.
To get into it, I think I want to just get into one of the topics that our clients seem to want to focus the most off, especially our higher net worth clients that own businesses, and that's like a tax component.
Mm,
So, as I talked about in my introduction, people do such a great job in the accumulation phase, right?
mm.
And then as they start to transition into a different stage of life, we start to have a more focus on the long-term taxation planning that's needed for them to meet their objectives and live the lifestyle they want. From your perspective, how important is tax planning for long-term wealth?
I think tax planning is extremely important for building long-term wealth. For most Canadians, taxes represent their single largest expense. And so even a small difference over a very long period of time, over 10, 20, 30 years, can result in a very, very large difference. And this is one of the only variables that we could control with a reasonable amount of predictability. So when you're looking at building wealth, you have your top line revenue and all your expenses, and the difference is what results in you building wealth. And by reducing your expenses, and tax being one of them, you could build wealth more quickly and preserve it.
And once the wealth has been built and structured properly, there's another component that we need to focus on, which is the protecting of that wealth. When our clients come to us and we talk about risks, the asset management side is such an important part of what we do, and people always tend to focus on investment risk and market risk. But we're trying to explain to our clients that there's so many other components of risk within your overall financial well-being. I was hoping you could share what you think some of the common risks you see are when you're working with your clients.
Of course, for higher net worth Canadians, one of the biggest risks is typically concentration risk. Usually they accumulated their wealth through a family business or maybe perhaps real estate. So that's usually a risk that's kind of overlooked sometimes. The other risks that exist could be a result of liquidity and tax risk that could come up, and those could be addressed through some planning opportunities. Family governance tends to be a risk, especially when we're talking about transitioning wealth or succession of a family business. Human capital is a risk. So suppose you can't go to work tomorrow, what's going to happen? Who's going to open the doors? What's going to keep the lights on? And then there's other risks that exist, and they just become a little bit larger when the assets grow. So that could be liability, that could be regulatory risk, that could be lawsuits, things like that.
Okay. On the concentration risk, we see that quite a bit too. As you said, clients that have built up a significant net worth in their business, clients that have built up a significant part of their net worth through equity in their company, even if they're working for a publicly traded company, or also clients that have built up a significant portion of their net worth in real estate. What do you see when people address that risk? Are there any specific steps they take to spread out that risk a little bit?
Sure, there's ways you could mitigate those risks. Sometimes you can't eliminate them entirely because it's such a large portion of their total net worth or their financial assets. But there are ways to mitigate those risks, and it's important to be intentional about them because that's one of those things that's often overlooked.
Mhm. And so back to what we started with, we talked about the importance of taxation planning. And would you classify tax issues as another risk within?
There is a risk to taxation. So, for example, there are certain events that could trigger a tax event, and we need to make sure that the liquidity is there to take care of that tax event. If it's not there, this could lead to very unfavorable consequences. It could lead to potentially losing a business or a family cottage.
Okay. And what are some of the options when we talk about generating liquidity to meet an immediate need?
Depends on what's triggering the liquidity. So uh, a common one could be death or disability that requires a liquidity risk. And so oftentimes that's addressed through products like life insurance or disability insurance. Uh, Another triggering event could be the sale of a business. And that could be sometimes mitigated again through, for example, the use of corporations or trusts or reorganizing the structure.
When you're working with more affluent families, what are some of the biggest tax mistakes you see or any efficiencies of the taxation component?
I think some of the common ones are sort of do-it-yourself planning or getting fragmented advice. So you might have a really good accountant or lawyer, but just like a symphony, if they're not playing in the same beat on the same key, it's not going to sound great. And that's something that we see quite often. The other common mistake is just starting too late and not taking that long-term view of how to plan for things. So a lot of times you put a structure in place and it becomes progressively more expensive, difficult, if not impossible to unwind that, rather than if you had put the correct structure in place in the first place, that would have saved you a lot more trouble later down the road.
Okay. Yeah. So to your first point about improper communication channels, right? We see that where it's kind of broken telephone, where you're trying to implement a plan and then the client is trying to have a discussion with the lawyer and then relay that discussion to their accountant. And they might not be too familiar or comfortable with the terminology that they're using. So we try to, in a way, position ourselves to be the main planner for that client, and we're the ones that coordinate everything between all the other professionals involved in our clients' lives. And then once we come to an agreement with those other professionals, then we will then propose the plan to the client. So it's just a much more streamlined approach for our clients.
I agree. I think that's one of the best things you could do for your clients is to act as that quarterback and the orchestra conductor to bring in these resources and be that one point of contact for the client, that trusted advisor for them to bring in all these different components of the plan and making sure that they're all speaking to each other and working in harmony.
Okay. Beyond the financial side of running and managing a business, how important is it to think about the family dynamics of operating that business?
I think it's very important. So when you think of a business life cycle, it goes through different phases. And for most generation one entrepreneurs, wealth creators, when they start the business, their focus is on making this business successful and survival. And then when that when they do a good job at that and the business survives, the next part becomes transitioning this business to the next generation. This is where the biggest risk is at this stage of the business. The business is running itself, it's operating well, and that risk has faded to some extent. But the biggest issue is right now making sure that that business transitions successfully to the next generation and the next and the next. And this is where the business family dynamics come into play. When you go from generation one, so or G1 to G2, it's usually a little bit simpler because it goes from parents to siblings. But then if you go to G3, now you're talking about a cousin consortium, and it becomes exponentially more complex and more nuanced the further down the line you go. And so the focus tends to be less on making the business successful and more on how do we make the transition and the continuity successful.
Okay. So if you're at almost a third generation business where now you have cousins, you have in-laws like son-in-laws, daughter-in-laws, you may have family friends working at the business. How do they structure that, or what's a technique that they would implement to manage on who gets what, who assumes what responsibility within that business, because it's becoming so convoluted of all these different family members and new married into the family people as well.
Yeah, so I think that's where governance takes a very, very important role. And governance is something that's done by the family and with the help of their advisors. And it could take different forms, but it could be in the forms of, you know, owners councils, family councils, things like that, and that's where those decisions are made, and it's decided who's responsible for what. It's clear on what the expectations are, what the roles are, how people are selected and elected into certain roles, and that's where the governance becomes very important in making sure that this business survives and remains in the family.
Okay, so if I'm hearing you right, essentially a third party neutral counselor would step in to help remove the emotional aspect of the family dynamics and give them guidance on who should be doing what within the business.
Yep, that would be very desirable to have a third party counselor involved. It could be certainly more than one. So you could have counselors on the family level, the ownership level, and the business level, depending on what the complexity and what the needs of the family are. And the counselor's role is really to facilitate this, but the whole conversation should be led by the family. And the counselor's role is really to help facilitate and lead those meetings.
Okay, that sounds very important because we've all heard of situations of businesses sadly coming to an end because of friction within the family and not operating to its full potential because of poor family dynamics. So that seems so vital, protecting the longevity of the business.
Exactly, and it's so tragic because people worked so hard to build this up, and to lose it over something that could have been preventable is just very tragic to see.
Absolutely. And the idea behind the life insurance component is that on someone's death, a business owner's death, the life insurance would be an instant liquidity injection into someone's estate to allow their successors to either fund a tax bill or to carry on operating the business. What do you see the main use
Correct.
of that for?
Exactly. So when somebody passes away, there's a deemed disposition on the fair market value of their assets at the time of death.
Hmm.
And when we're talking about especially business owners or where there's cottages involved,
Hmm.
there's sometimes very large unrealized gains within those assets. And so when that individual passes away, that's going to trigger that tax liability.
Hmm.
Now, ordinarily, when a tax liability is triggered, you usually have an offsetting revenue come in. So you earn income, it
Hmm.
creates taxes, and you use that income to pay it off. But here, you have that tax liability being triggered, but without the corresponding liquidity because the cottage or the business still remains with the family. You need that liquidity to be able to pay off that tax liability. So that could be done with life insurance, which is a very effective way of creating that immediate liquidity to cover the taxes, or it could be done through different means, such as just putting money aside for that need.
Putting an emergency fund aside to prepare for that. And if someone doesn't plan for those events, worst case scenario, they might be in a position where they have to sell the property, or what would they have to do with a business situation if someone hasn't planned properly, if they're wanting to keep that business within the family?
Yeah, I think worst case scenario could be quite extreme.
Hmm.
Even the moderate case scenarios, you're just forced to do something at a inopportune time. So, at a time where a family might be grieving, now they're trying to find liquidity, or you might have to sell an asset at fire sale prices or when the
Hmm.
market opportunities aren't great for it. So planning ahead of time can really, really preserve the wealth.
Absolutely. And especially to the point when someone's grieving, right? It's very difficult to make serious technical decisions when you're just dealing with the loss of a family member.
Correct. We know that psychologically, when people are grieving, it's hard for them to make objective, smart decisions.
Hmm.
So, on top of the grief and on top of the stress that's being caused, sometimes people just make irrational decisions.
Yeah, and that's a serious issue that could be not avoided, but mitigated with proper planning and a few
Exactly.
years in advance.
Exactly. So, planning could set you up for success or,
Hmm.
again, mitigate the risks
Yeah,
of losing something that you've worked so hard to.
exactly. And make things a little bit easier on your family, especially if they're not well versed in some of the technicalities of personal finance, taxes, and estate planning.
Yeah, you pointed out to a very, very important thing as well, because oftentimes, again, going back to the example of the business owner is very involved and very familiar with how things work. Are their family members and successors as familiar with the situation as they need to be? Are they going to be able to pick things up where the way they were left off? So that knowledge transfer may not be there.
Hmm.
And again, with planning, you could avoid a lot of the potential uh, unfavorable results that come from that.
Okay. So on the topic of business owners specifically now, um, if you have parents who started the business and grown the business, now the younger generation, the kids or the son-in-law or the daughter-in-law have entered the business, and the the founders of the business want to keep it within the family, transition it to the next generation. It'd be great if we can talk about what are the steps that people should be putting in play to prepare for that stage, how many years in advance they have to start, and what other risks within the family, especially within family dynamics, could cause issues for that transition.
Yeah, so succession planning and continuity planning are extremely important. I would say oftentimes they're overlooked and they're left to the last minute, or they're really treated as a transaction, maybe 3 years before the event or the retirement or the sale of the business. But really, it's a process that should be taken over a very long period of time. So I don't think it's ever too soon to
Mhm.
start, but I would treat it as a continuous process where succession and continuity is placed on the agenda regularly on the AGM,
Mhm.
on the board meetings, even if it's a decade away.
Mhm.
Um, it's important to set expectations. It's important to have clarity as to how things would unfold.
Mhm.
Um, and that's how you get that seamless transition and mitigate all those risks that we talked about earlier.
Mhm. And so these transitions take time, right? And maybe a decade of time to implement. Um, is there kind of from your perspective, is there an order of tasks that need to be accomplished, or like what's something that should be prioritized right away, even if it's in the early stages of that transition?
Yeah, so I don't think it's ever too soon to have those discussions.
Hmm.
Some of these discussions really take time. So the decision itself can take a couple of years to be made.
Yep.
So, for example, if you want to put in place a unanimous shareholders agreement,
Hmm.
it's quite easy to draft one up pretty quickly, but it's what goes into the shareholders
Yeah.
agreement that could take 2, 3 years to reach an agreement
Okay.
on about how it's going to be
Yeah.
drafted.
Could you just quickly explain what a shareholders agreement is?
Sure. A shareholders agreement is basically an agreement between shareholders,
Hmm.
as the name suggests, and it outlines um, what it creates clarity and it outlines what happens under certain circumstances. So, what happens if a shareholder, for example, passes away? What happens if a shareholder wants to exit the business?
Hmm.
How do we bring in new shareholders to the business? How do we treat a sale? What happens if somebody gets divorced? So, all of these what ifs,
Hmm.
some of them could be planned,
Hmm.
such as a sale, some of them could be unplanned.
Hmm.
Uh, those are planned for ahead of time. So when and if the time comes, everybody's clear on the process that should be followed. And a shareholders agreement could include things such as how is the company going to be valued? How much
Hmm.
time do people have to buy each other out?
Yep.
All of those things could be included in a shareholders agreement. And usually, as a byproduct of that shareholders agreement, then you implement the mechanisms as to how these things were to unfold. So, again, say somebody passes away and the remaining shareholders would want to buy out the deceased shareholder's family,
Hmm.
where does that liquidity come from?
Hmm.
And that could be planned for again through tools such as life insurance or
Hmm.
savings and things like that.
Okay. And then it's always wise to have the next generation involved in that decision-making process, or to coach them as the years are approaching on the responsibilities of running the business and the technicalities of all these concepts that we've been
Absolutely.
talking about.
Absolutely. Communication, communication, communication.
Hmm.
And I think sometimes business owners have a bit of reluctance to bring in the next generation too early.
Hmm.
Uh, Bringing them in at giving them a seat at the table doesn't mean they get a vote, but
Yeah.
at least they get a voice.
Hmm.
And creating that clarity and setting expectations is very important.
Hmm.
One of those things that often comes up with the next generation is, for example, in-laws,
Yeah.
what their role is within the family.
Hmm.
And that's not for, you know, us or the lawyers and accountants to figure out. That's for that family to figure out for themselves.
Yeah.
And those are part of the ongoing discussions that they should be having with the
Hmm.
next generation.
So basically, all this planning is to make things smooth, easy transition, and give peace of mind to everyone that's involved.
Exactly. Nobody
Exactly.
likes surprises.
Of course, yeah. And speaking of like peace of mind, just transitioning to a slightly different topic, we've talked about the transition from the accumulation stage, right, to the management of a higher net worth, but then also the transition from an active lifestyle of working in the business to a more relaxed lifestyle of enjoying a retirement. Do you see any difficulties that people have in making that transition, either as a business owner or a corporate executive? How do people make a good jump or comfortable jump to that next phase of life, keeping their mind preoccupied and, enjoying everything that they've accumulated?
Yeah, that's a very common challenge that particularly business owners and executives face. People who have a very busy lifestyle and a big part of their identity is tied to what they do in their profession. And it's important to have something to go to
Hmm.
with that transition. So that could include things like hobbies, giving back, sitting on boards, spending time with family. But when this void is created, you have to have something to go to.
Hmm.
And different people approach this in different ways. So sometimes that could be um, accomplished by slowing down and having a more gradual exit from the business or the day to day.
Hmm.
Sometimes it's done by sort of taking a sabbatical and having a trial run of what retirement could look like.
Yep.
And that'll answer a lot of questions for people.
Okay. I've seen in our practice the people that have made a successful transition to into a more relaxing stage of life is like a need for social involvement and social clubs. So charitable foundations, car clubs, organizations like that, golf memberships, right? All that stuff to me, from what I've seen, is exceptionally important.
Absolutely. We are social
Yeah,
uh, creatures. And I think it's really important for people to really just have purpose in their lives and um, have a reason to get up in the morning and go about with their days.
absolutely. Well, Ahmad, I just wanted to thank you for joining us today. Very insightful. We talked about a lot of important concepts that we have discussions with our clients about in our practice. So, thank you and appreciate your time.
Thanks for having me.